Please subscribe, like, and hit that notification bell. Thanks, guys. The intro, Kevin. We're on, Kevin.
That's it, Pat. Lights, camera, action. Welcome everybody to another talk with myself, Kevin Wadsworth, Patrick Karim at NorthStarBadCharts.com, and we've asked back a guest that's always very popular with everybody out there. I think we've got Henrik Zeberg with us today. Hi, Henrik. How are you doing?
Doing great, thank you.
Good stuff. Listen, I was saying before we started recording, there's not very much going on in the markets, is there? And it's all very boring, and perhaps we can just go away for a year and nothing will have happened. Or then again, on the other hand, perhaps things are a little bit more interesting. I know we've I'm just joking, of course. We've seen the inauguration of the new President of the United States, and there's a lot going on across the European Union as well, and around the world, across Asia and further afield. So a lot of macro drivers to what's going on at the moment, right across the markets, of course, and a lot of confusion out there for many investors. Stock markets, precious metals, commodities, currencies, all seemingly in turmoil at times. So let's start with where should we start? Well, I know. Okay, we'll start here, shall we? President Trump has said that he is going to tame inflation. He's going to stop inflation. Sounds like he's going to save the markets, and he's going to send cryptocurrencies to the moon. What do you make of all that?
Well, I think it's amazing if one person can just say, "Well, we're going to stop inflation," then inflation stops. So that would be fantastic, right? So if that's the way we can do things in from the future, I would very much like that. I don't think that's the way things work, and obviously, and I think it's things are obviously in the economic system based on supply and demand, and I think one thing we've seen with inflation coming in here this time around is that just like in 1980, 182, when we saw Volcker coming out and killing inflation, we actually saw this time around when we saw the stimulus coming out after the Corona, that we actually saw the opposite. The Volcker here. So what we saw the moment there was actually when we reintroduced inflation. I don't think it's a right now and here problem. I think it actually inflation is moving down as we speak. You can see that if you look at the rent inflation and so on, and that's actually having a strong momentum to the downside. So I don't think that's a here now problem. I know it's something that is perceived as a problem because prices went up and they are kind of sticky, and that is the problem with inflation. But in terms of the way we look at inflation as a yearly increase, I think it's not such a big problem here. But the problem is on a longer term scale here. I think we have moved into what I call a new inflationary regime, which is actually that we are now should be looking at what did we see from the 1950s into the 1970s, and not so much what we saw from 1981, 82, and until 2020. So I think we over let's say the Fed and the central banks of the world and all the administrations of the world, they overdid the stimulus. They stimulated into a supply crisis, and that you don't do, because if you do that, you add to stimulus, and then you just you add to demand, and then you have a lack in supply, and that's why you see inflation coming in. And the problem is then if people then start to adopt that and say, well, now inflation is here, that's not something that one person can go out and say, oh, I'm just going to bring this down. So I think this is the problem of the whole thing. It's actually something that has gotten into our spines now, that inflation is actually a thing that could come out again.
I was just sorry, I was just unmuting my my microphone there. So that bearing that in mind and looking at what's going on with let's say bond yields at the moment. I mean, bond yields in the United States, looking at the 10-year yield, for example, as you say, has been very sticky actually, somewhere between sort of 4% and 4.5%. Hasn't really pulled back very far. I know a lot of people were expecting it to come back all the way back down to sort of 1.5 to 2.5%. That didn't happen, and it's just started breaking out again. Bearing in mind the debt burden in the United States and the fact that the interest rate on that debt is proving problematic. You mentioned the 1950s to the 1970s. I mean, we kind of know what happened then, and I think you've quite rightly identified the similarities between that and anything that happened from 1980 through into 2020 there. So that that change of regime, change in regime of bond yields, how do you see that affecting the markets? Do you see that having being a major concern going forwards?
So yeah, obviously, I mean, in the long-term perspective, this will have a major will be a major concern because obviously when yields are going up like what we can on a longer-term frame, and again, we have to distinguish between what I think that's going to happen the next year and a half, maybe even 2 years, and then after that. So if we go past those 2 years then now and then say what's going after, then yes, then it's going to be definitely a problem for the US debt, for debt around the world, that we're going to see inflation, sorry, yeah, inflation going up, but the yields also going up. And I think we will see that that can cause a lot of problems down the road. But I have to say also that when people are looking at in yields right now and then saying, oh, it's not come down yet, and then they also have to understand that in the world, in the economic world, and the way I look at things, and you have leading indicators in the economy, you have the coincident, and you have lagging. Leading indicators are the ones that tells us where we're heading, and this is like the yield spreads and the like. So when you have a yield spread and it inverts, you have the risk or very often you see a recession. Then the recession sets in at a later stage. It can take up to year and a half, even 2 years before you actually see that recession. But that brings over the coincident indicators, which are the labor market, which are the non-farm payrolls and so on. And then after that, you will actually see that inflation starts to drop. So the lagging indicator is inflation and yield. So when people are saying right now, we don't understand why inflation hasn't come down yet, it's because the economy hasn't rolled over to strongly enough yet, I would say. So you would see around the world, you're starting to see these deflationary pressures that we see. We see them strongly in China right now, but you also see them elsewhere, and you can start to see them in Europe as well, where you can actually see that we have negative price development month by month now. If you look to the US, we still see that standing strong, and we see that the labor market, which is that middle one there, so you're leading, coincident, and then the lagging, that the middle one that needs to start rolling over, and that's what people don't see right now. Then say, well, the labor market is so strong, and so we expect that things are normalizing. We're not in a normalized world here, as I see it. We're still in a world where we had the largest yield spread, inverted yield spread ever, bigger than 1929, bigger than anything we've seen before, and across the curve, across everything. So this is not something we should just look lightly at and say, okay, no, okay, that's all gone now, so let's go ahead. When we see that yield spread and that inversion, we need to look to it when it starts to uninvert again, and when it starts to spike there after that and accelerate upward. And that is actually only what we start to see now on the 10-year minus the 2-year yield spread. And we only see, and we tend the 10-year minus the 3-year month actually starting to have uninverted very powerfully here. So that people are calling everything off now and saying, oh, everything is fine. They need just to look to history and understand when you have the biggest of something, it may take a little longer for it actually to unwind and to start things to happen. And if you go back in the 90s, you will actually see that the yield spread inversion from the point of when we had the spike when it was mostly inverted to the point where you saw the recession, you had 15 months. Now that was just an ordinary, crisis, season kind of crisis we had there. This time around, we have the largest bubble in the world. We have just had the largest stimulus ever, bigger than Marshall Aid, coming out to Europe, to trying to rebuild Europe after the Second World War. We threw that into the economy after the Corona crisis, and then we say, "Oh, we don't understand why things are not developing faster." I can tell you why. It's because people have been, of course, saving up, and you saw savings, soaring after the Corona stimulus coming out, and you also saw businesses actually building up capacities a lot. So when you have those two components into it at their maxes, then of course people will spend their money, their savings, before they actually start to reduce spending. And second of all, businesses will also start to say, well, let's look at this if things are not going to turn out fine. So that we have had a little extra period here, as what we have seen earlier, is due to those factors, as I see it. So I don't think things are great here, and I think what we're going to see with yields then is that the labor market is going to deteriorate. It has been stronger for longer than I've expected. I'll give it that. I give it that, but it's not the same as saying that's not happening. And I'm still seeing that deterioration. And if we look into the numbers, for instance, the 256,000 numbers that we saw in December, we actually saw that had the lowest correction, seasonal correction to that we had seen in 20 years. So if you had a normal correction, December correction on that, you would have seen that number was way, way lower. And you would also see that the household survey actually in November actually told us that we had 355,000 loss of 355,000 jobs, difficult to say, this in November. So I think we need to take these things with a grain of salt and then saying, okay, just because it hasn't happened yet, it's not the same as that it will not happen. And I definitely say we are still running in the wrong direction here. Things are not great. And when that starts to develop, then you'll see yields coming down. Then you'll see inflation coming down fast, and also that we are looking at what I'm seeing here with the yield spread like this now starting to run up as high and spiking like what we see now, which could trigger an inflation. We could show us that inflation could be closer, and we have inflation rate at 2.7, 2.9, I can't remember now, just last week. That is the lowest number we have seen for the beginning of the last 7 recessions where we had deflation as a problem. So imagine if I'm right, and we have the largest debt we have ever seen, we have the largest bubble we have ever seen, and we have such a low inflation, and things are starting to roll over. I think the Fed will be very, very busy in fighting deflation before we know of it.
Man, it's yeah, like the yield curve on inversion. Like you could overlay the U.S. initial jobless claims, you could overlay the unemployment rate, you could overlay these charts. They look practically the same, and the unemployment rate off the bottom is up over 25, 26%. So I know some people say unemployment rate's still low. Well, hold on, it's trending upwards, and I think it's never went up over 25% off a low, the unemployment rate, and not be in a recession right after. And I think that's what's
Correct.
spooking the Fed, why they keep cutting, because they're looking
Correct.
at the unemployment data, and people, oh, why are they cutting? The market's so high. They're looking at other stuff,
Yeah.
and they're seeing what you're seeing, and they maybe they're not cutting fast enough. I don't know, but it's like
I don't think they are. I
they're
don't think
fast
they're
enough.
cutting fast enough. Absolutely. I mean, it's like Newton's. This is the second law of Newton. I think when you need to start applying, and probably it's wrong, but I think it is. You need to start applying a force in the opposite direction.
Mm.
So the problem with this is that we are all living on this supertanker called the economy. And when that super tanker start to turn, you will need to start applying force in the opposite direction before you actually find yourself heading towards ground. So when you're looking at things, oh wow, we need to turn it now. Well, guess what? You cannot turn it this quick. And the problem is with the rate cuts is that when the Fed comes out and say, oh, you know what, we do 25, and they do like a chef going out and doing a seasoning the salad there, right? Oh, 25 basis points because we didn't. Guess what? You and I, and I don't think we go out and say, oh, wow, they cut by 25 basis point. Now let's go spend money. We don't. We think, oh, we saw inflation last year. We in the last few years, we saw yields going up, or my rates are, I'm paying a lot on mortgage here. So would I go spend those money, or would I actually save them? And this is the problem with it. There is an elasticity in that, first of all, when you start to supplying that kind of stimulus by lowering rates, and when it actually comes through in the fact when this consumer starts spending that money, because if they don't spend it, it doesn't help. So this is the real economy. It needs to be spent. It needs to be bought products, services for that. And we need to see that. And if you do not start to apply that kind of force in the opposite direction on the yields now, on inflation now, then you will have a problem down the road. And guess what? The Fed is always late.
Yeah.
Why? Because they look at the inflation. And inflation, as I just said, is the lagging indicator. You can just think about it. When things are being produced, they have a certain price, and then when they have a cost at that moment, and before it actually gets all the way through the whole funnel of things, it can be on a storage for such a long time and so on and so forth. It takes a while before that inflation actually triggers through. So it is a lagging indicator on the economy, and that is the problem of this, that the Fed is actually looking out the rear window and saying, no problem, you can see we're all good, we're all fine. Yeah, but you need to look that way. And that way right now is telling us that we got so much, coming against us in terms of the consumer actually having problems, which is, if you look at the delinquency rates on mortgages, if you look at on the credit card delinquencies and so on, that's the consumer stopping, trying to make ends meet. And if he's struggling on that and he has 1 or 2 jobs and 3 jobs sometimes, right? We don't see that so much here in Denmark, but I know that's a US thing also, because they want to make ends meet. I understand that. but that is counted for in the non-farm payrolls as 3 different jobs.
It is.
And that's not 3 different jobs. It's one job. It's one, struggling guy, one consumer. And I think this is the problem, that we are looking so much into these numbers, just saying, one job is one job. No, it's not. And looking at the part-time jobs over the last year, if you look to the household survey, you will see that the full-time jobs have dropped a lot. The part-time jobs have gone up. That is not the strength of a strong economy.
Did you look
Is
at, I
it?
looked one time at I found this data series called job openings. So it's kind of the inverse
Yep.
of unemployment rate. It has been downtrending crazy for a while.
Yep.
And every other time there was a recession, I'm saying, where's my recession? It's like
Yeah.
they're stretching the envelope. It's like,
Yeah.
what do you think the black swan is going to be there, like for the
So
SPX
so
group?
so normally we don't experience this recession as it sets off. So I don't know how you remember this, guys, but in 2007 in December, that was the beginning of the recession into the financial crisis, and I don't think too many people actually realized. I mean, Bernanke didn't. So he was standing there in 2000 and on in February 2008 and saying there's no problem here with recession. We will stand ready if anything happens to that. Problem was we were already in a recession at that point. So that's not like we're going to have the Fed is going to tell us this in advance or anything. It's not like and the consumers will not be feeling it. It's only at the point when we something hits the fan there, and this is where recession will set off at some point, and we may not see it, but we will see it when something happens. That was what happened with the Bear Stearns in March of 2008. That was what happened in the really bad way with Lehman Brothers in September, when the recession had been going on for 9 months. So the thing is, the recession could be upon us. I don't think it's here now, because my indicators, the 2-year yields needs to drop a lot, will become upon us before we realize it. Then 6 months down, 9 months down, we'll see that the NBER and others will start to say, "Oh, by the way, we had a recession starting there," and then people, "Oh, freak me! That's why I got fired and whatever." So we will not realize it like that. There is nobody ringing the bell there. What we can observe is what happens in the market, and what we can observe is what happens in the unemployment that you rightfully brought up here, and saying, "Oh, didn't we see like a rounding bottom of that? And by the way, didn't we see a yield inversion?" And when we have these two factors in place, and my business indicator that I have also, we have those 3 in place, you have never, ever, ever seen that we will not have a recession. So it may be that the structural crash we have had with Titanic here has not, brought the ship to sink yet, but does it mean it doesn't sink? I think it's sinking. And I think we are having we will see this later on. So the black swan, back to your question, is that the black swan will come later. And I think with the kind of stretches, I would say, stretched valuations we have around the world, you're actually starting to see some of them. And I think you'll see a continuation of that in Japan, for instance. You're seeing it in China. There are problems there also. That's some of the black swans that can come out, because that's deflationary pressure that will come upon the world as well. But in the US, there will be problems with private equity companies. There will be problems with commercial real estate. There will be problems with so many places. I mean, any private equity over the last 10 years who haven't been able to find yields for its investors have simply not been business. So they had to go find and buy any ridiculous business setup that they could find and pay extreme money for that. So we are seeing that already. We have the stretched in this, and by the end of the day, if I'm right, and we get a recession, then the black swan will come. It's just a matter of where.
There's,
And the financial institution, unfortunately, will again be the ones that will take the hit.
there's something else that people probably want your views on, and that's particularly around gold, I think, and what happened in the early 1930s, the early 1970s, and the early 2000s. We saw in all of those occasions the stock market going down a heck of a lot, and you only have to go back to the period between 2000 and 2003, 4. We saw the stock market, the SPX, falling 50% twice actually. The Nasdaq fell 80%. Same sort of thing in the 1970s, and of course we know what happened in 1929, 1930. So those 3 occasions, stock markets plunged. Took a long, long time to recover. Took a decade to get back to where they had been. And of course, gold during that time had to be repegged in the 1930s because of the pressures were so high. caused by that. So gold was repegged at least 60% higher. And then in the 1970s, of course, gold doubled, and then it doubled again, then it doubled again, and then it doubled again. After the year 2000, gold doubled, and then it doubled again, then it doubled again. So here we are now. We're looking at another stock market, for want of a better phrase, we'll call it a stock market event. So we're getting the piece of the jigsaw puzzle in place for another event similar to those ones I've just described. So assuming that the stock markets roll over in the not too distant future and they do suffer declines that are historically comparable to previous ones, then would I be right in thinking that you would expect precious metals to, after perhaps an initial drop, to outperform the stock market? So that's the first part of that question. Will gold outperform the stock market, gold and silver? And second sort of side question, I know a lot of perhaps crypto fans will be watching this and thinking about Bitcoin. Bitcoin, of course, only has a fairly limited price history, but the evidence so far is that it tracks very closely tech stocks and the Nasdaq. Would you expect Bitcoin to start behaving more like gold, and would you expect Bitcoin to outperform on the recovery? So when the stock market has bottomed, would you expect Bitcoin to outperform on the way back up? So two questions there.
So first of all, I think if we lived in let's say we lived in a world where we only had the SPX and we had gold, and then we could look at the ratio and say if we had the ratio was going up, it means that we should be in SPX, and if it went down, so SPX versus gold, then you will have to be in gold. Now we have that third factor actually, which is the dollar, and the dollar will has its own kind of value. It has
Of
a
course,
value
I should have
also when
mentioned the dollar
especially.
there, that because the US dollar index has been rising strongly, and that
Yes.
hasn't done anything to stop gold going from 2000 to
Exactly,
28.
it hasn't. It hasn't right now. I agree with that. I think I'm actually at I always say I always being told that I'm so bearish on gold, and I would still say that into a deflationary bust. I will say, as you also kind of alluded to here, that we would probably see an initial decline first. I think so too, because I think there's actually going to be a bigger one, and I think you can compare it again to 2008, where you had the first part of that the recession, where the Fed was not really aware of it, and there was not enough liquidity in the system. That is normal, a part of what you see into a recession. That is deflationary bust, and especially if the air comes out of a bubble like what we have now, liquidity will be a problem. And for a while the Fed gets their acts together and start understanding that they need to come in with the bazookas. The moment they come in with the bazookas, really the big thing, then things will be fine and gold will do like this. And I think the next move here from gold after that decline will be extreme. And I think your doubling thing thesis there can be absolutely what we can see into the 2030s. And I think I actually made some charts on that, and I could see, and hold on here. I mean, 36,000 on an ounce for gold coming into 35 or something like that. But that's not the straight way from here. I think you're gonna see that because gold actually seems like it's been outpacing the other metals, let's say like that, right? We don't see silver, we don't see platinum, we don't see the miners, gold miners, performing like gold. It seems like gold has been speaking itself a little up, or at least the narrative around it. So maybe it's been front running things a little too much, and I think that, and again also with silver, could take a hit before we see it into the deflationary bust. So while the balloon is, so to speak, declining. But then said again, that's back to my story on the ratio. So saying if you'd only had the if you only had the SPX and gold, and you're looking at that ratio actually, and you'll actually see very interesting if you go and do the SPX gold chart. It seems like that is rolling over. We reached the same kind of height and level that we had in 1971, just around Nixon's speech and abandonment of gold convertibility. And it seems like that could send us off for that extreme move in the ratio. And that we could even see at a time where the dollar relatively could strengthen towards both of them, because simply the SPX would fall and gold also will drop. So you could even see there that gold can actually hold up relatively well, towards that. And I could see that scenario absolutely. But I think the moment it'll perform better than the Dixie is the moment when you see the bazooka. At this point here, I'm a little interested in seeing what I'll come back to your Bitcoin in just a second here. Um, to see whether we are actually going to see with the, I think we see now with Trump's inauguration and what we just saw that we've seen as a top here in dollar for now, the Dixie for now. And I think we could see the dollar actually now moving down below 100 again. I could see 94, 5, 6-ish. Let's stay on the higher side, 96. And then in that moment, in that phase, potentially even gold maybe have another high to it before we actually see it roll over. So I could see 3,100, 3,000, something, 30,000, 3,000 on it before we actually see the top there. But I would still think that at the moment we start to see that deflationary pressures then coming out, that gold for a certain while will not do so good. After that, I'm all with you. And I already I have a good long list of gold miner stocks, silver miner stocks that I'm going to buy into. The whole commodity cycle that I think can unfold from that moment on. Because again, if we think about that, as what I said before, with the new inflationary cycle, if the Fed really thinks they can come in one more time and doing another free lunch of just, shooting money out there and everything will then be solved again, I think we're going to see that with gold and commodities and things just taking off in a really bad and in a fantastic way for us who will be long it. But I think we need to wait for that moment. And then versus Bitcoin, I think Bitcoin will do even worse than gold into a deflationary bust. So Bitcoin will be taking a very big hit. I'm been very bullish since the bottom in 2022, and I am now starting to think that we could see the 125, 20 around 25,000, 125,000 that we could see as the top. But I could also see it in a crazy world. I need to see if it in a lock chart or an unlocked chart that it even goes to 250 in this cycle. The next few days here will actually decide how bullish I'll be on that. But I think into that deflationary bust again, you'll see crypto and cryptos, altcoins, meme coins get annihilated completely. Bitcoin also getting destroyed and can drop a lot farther than most people will understand.
Are we
Because
talking
by the end
about
of the day,
fart coin and these meme coins that might fall 99%?
yeah, or 99.999%. I mean, forget about these things I think we've been living in a fantasy world here. We've been living in a world where we have, artificially low yields for such a long time. And obviously that distorts the economy. What we mean by that is that people start to think, where can I find yield? Where can I find something? Because I can only get 0% at the bank. And then it's okay to go spend your money and invest in a doubtful startup, which you then keep putting money into, or putting your money into something like Fartcoin or whatever. I mean, this is under attack now by the inflation that we've seen and under the rates at levels that we have. But I think simply the hype is so strong at this point that when the recession is going to fall out, that's when we see the shit hits the fan there on that. So I think Bitcoin can take a very big hit on that. And I almost don't dare to say how much because then people will look away and just say, oh, he's just, yeah, whatever, stupid again. But I think it'll take a very big hit on this. And then it will be interesting to see which coins, which of these will actually stand through the crisis
Mm.
and from which levels on. So could we see, I mean, I think we're seeing the birth of a new industry here. I think I could see resemblances to the crypto industry to like what we saw on the NASDAQ back in in the 90s and into the 2000s. But we also know that, as we talked about earlier, NASDAQ took a dive of 81% on an average, and some of these assets there they disappeared and never saw the daylight again. I think you will see that with a lot of the crypto, more of the cryptos than we did with the Nasdaq stocks, and that's where the problem is for. I mean, that's the problem for the crypto now. Which one will be able to go, endure this? Which one will have a sustain, something of a real value in a real world also? And I think that is where Bitcoin will also get outperformed by gold for for foreseeable future.
Yes. Look, I don't know. Sometimes you get a bad rap, Henrik, but it's all about time frames, and often it happens to us also. Let's say I put a long-term chart, and then the short-term bearish action. Patrick, your targets. Well, look, I was showing you monthly, quarterly candles. Like I don't care about the daily chart and inverse. If I have a short-term, I could be bearish and long at the same time. I could be bearish short-term, like you're describing deflationary bust, but after that, you hit some longer-term uptrend, and it's good to nuance that. And we're trying to. I don't want to say educate people, but people are always binary. Are you a bull or a bear? What?
Yeah, exactly.
No, you could be both at the same time. It's time
You can
frame.
be both at the same.
Yeah.
Exactly, depending on time frame. Exactly. So let me put it like this. I said in 2022 that we will reach a level of around 6,000 on the S&P. As closer we get, the more you can define the Fibonacci's. All Elliott waivers here, they're using Fibonacci's, will know what I'm talking about. So you can actually know, you can get into the shorter time frame, and you can then see where you'll hit. Now I got an S&P target, which is within what I said back then, of around 6,500, and that's it. That's my target for the S&P. Did I think it would happen sooner? Yes, I did. I did think it would happen sooner, and I did not see that the labor market could actually stand for such a long time. Again, I have to question also what I've seen in the labor market, because I know was it September, all of a sudden there was a million new governmental workers in the US, where you normally would just have seen, I think it's not, I wasn't a million, it was 700,000 extra in 1 month. I mean, there were some of these numbers that were just so strange, and we have to look at them here. And there will be a revision now in February. But did I actually foresee that it could be? No, I actually thought that things were unfolding faster. Does it mean that I went bearish then? And I said, no, okay, now it said, because I said it was December, so hence I went December. No, then I went bearish and in short. No, because I'm waiting for those Fibonacci levels to get hit. And I want to see also the entirety of my model actually starting to show that we are there. So it's taking longer, but I'm fine with that because I've been bullish all along. So still bullish, and I'm very let's say exposed to risk at this point here. And that means that if we have this blow off, the final move here from up to 6,500 on the S&P and Nasdaq even further, I mean, I can't remember the target now exactly, but 24,000 I think is easily seen on the Nasdaq. Then I'm in that part of the game as well. But knowing also that we are not right now riding the largest bubble, and it can pop really quick. And I think people will realize that. And honestly, I still say, and I called that back in July also, the Nikkei has topped, the Nifty has topped. You see various tops in Europe already. You have seen that the potentially also the Dow Jones topped, and I said that in December, 4th of December, I think it was when it topped. And the XLI, which is the industrial sector of the S&P, potentially also topped, which means that what we're seeing now is not a general market move up. This is a rotation from the broader market into a very specific part of it, which are the tech stocks and the AI and the AI related stocks also, and crypto. And that is completely different. So you can sit and look at that and say, oh, but everything is fine and nothing is happening. I can tell you there is a very big, and if people just go look on the S&P and the Nasdaq, if they understand what is negative divergence on the weekly chart, they can go take a look, and then go back in time and take a look at when you have seen negative divergence on the S&P on a weekly basis, and what that has brought about after a certain time. So when we hit that and we start to see the top around 6,500, then I'll turn bearish, and I think it will happen sooner rather than later. I don't see us going much into February before we actually see that
No,
top.
so it's a fascinating set of charts when you actually look at the cryptocurrencies, because I agree with you. There are a lot of indicators out there now that say that the market top is very, very close. But then I look at the cryptocurrency charts and I look at the struggle that Bitcoin is having to clear the, let's say, 105 to sort of 109 level. And then I look at the altcoins. Now, in a mania phase at the end of a cryptocurrency bull market, the altcoins very strongly outperform Bitcoin. And looking at the charts at the moment, I get that some individual coins like XRP and one or two others have had some very exciting moves to the upside. But if you look at the altcoin index and do a ratio of that versus Bitcoin, it hasn't properly broken out yet. So we have not yet seen what would typically be referred to as an alt season. And an alt season normally lasts many, many weeks. So 2, 3 months. And I'm just looking at the charts thinking we're starting to run out of time here. And if Bitcoin does only go to, let's say, 120, 125, that's a much smaller bull market than the last bull cycle, which itself was a smaller bull market than the previous bull cycle, which was also a smaller bull market than the previous bull cycle. So what I'm saying is that Bitcoin over the last 4 cycles has been losing momentum at each new bull cycle. It's been making smaller gains for a shorter period of time from the breakout to the top. So something is going on with Bitcoin, some momentum loss. And if we do only get to 120 or even 130 or 140, it's a smaller blow off phase of the bull market compared to previous ones. And when you combine that with the fact that the altcoins haven't really properly started to do their thing yet, and I just get the feeling that either we're about to see a massive surge that blows everybody's minds, or there's going to be huge disappointment. And I can't quite decide. Like you, I'm waiting for more confirmation on this Bitcoin chart to really sort of make it obvious what's going to happen here. Like we've been bullish on Bitcoin for quite a period of time now, with some relatively easy trades in the crypto space. I've mentioned XRP, XLM, and others as well. So that phase hasn't been too difficult, but now Bitcoin is kind of really hitting its head here against that level. It's a fascinating point. And
you normally see into the last phase of it if you just compare it to 2020. Actually, I don't think we are in 2021 scenario. And again, I also want to emphasize that we are if you look into 22, there was actually a high on the Bitcoin, but the 21 was actually the top in Elliott Wave terms.
yeah,
Anyway, if you look at the 21 scenario, you'll actually see that uh, when Bitcoin started to top out, altcoins were a little late in that. So in the final 5 moves up you had on Bitcoin, you'll see that altcoins were actually lagging somewhat behind after that. And then all of a sudden they start to take off. And in the final phase of it, actually Bitcoin had already had its high in, and altcoins were then topping out 4 weeks later. The
yeah.
reason I actually, and this is back to the also how I do my estimation and also and everything in terms of how long things will take, was that back in 6 months ago, I probably had a little of a difficulty by seeing that Bitcoin could disconnect with the S&P, S&P and the Nasdaq. I see that now as a possibility, and not only a possibility, I think that's going to happen. That was my shortcoming back then in terms of seeing that. I think now that it's actually because Bitcoin and crypto will be so dependent on the moment when we start to see liquidity, when the Fed starts to become more bearish, not so hawkish, and actually will lower rate and actually maybe even do some panic cuts or whatever they could find, could come up with, and that will have an effect on the crypto and on Bitcoin. So I think we are still in the phase where things can disconnect, decouple for a while, and I think you're going to see that Dow Jones actually decoupled, already in the top in December, and then you will see that the S&P and the Nasdaq kind of putting in their tops now in February maybe, and then you'll see Bitcoin maybe in March, and you can then see altcoins 3 weeks, 4 weeks, a month, around that later. So I think that is what was my shortcoming earlier on, that I had to kind of connect Bitcoin, because I thought, okay, how could we see Bitcoin actually doing well in that kind of environment where the S&P and the Nasdaq topped out? And the thing is that potentially we're going to see that that it's simply about the stimulus that we're going to see is going to be so dependent, that Bitcoin is going to be so dependent on the stimulus. The same goes for crypto, and that in that environment you don't see the Nasdaq and the S&P starting to decline strongly, but you will see that they top out. They don't actually go up again, but they have kind of a bounce, and then you start to see it. In that environment, I could see that the crypto and and Bitcoin could do well.
They're sort of sucking that last bit of liquidity.
Yes.
You kind of
But
draw it, that
yeah,
final bit of liquidity before it all goes pop.
that's great. I just want to mention
Yes.
one thing, just it's a thought I had there, a chart when you said the breadth, it was shrinking towards. I did some breadth charts, percentage of stocks for the SPX, Russell, and NASDAQ, the percentage of stocks above their 200-day moving average, it has
Yeah.
plummeted, and now it's doing
Yeah.
it was stretched, like the breadth was getting really bad, so now we're having a bounce, but it's a bearish divergence there. So even if the NASDAQ's doing a new high, the breadth is not
Correct.
confirming. In a true bull
Correct.
run, you have the breadth, you
Yeah.
have a lot of stocks, above their 200-day. It's not
Correct.
happening now. So for me, that's
No.
like step one. It doesn't mean you go bearish. You wait for actual price to break down, but hold on. There's no low risk entries right now. It's like if you're in the ride, you
Exactly.
could ride it, but entering now,
Exactly.
like it's kind of
And you
weird.
need to be in the right stocks also. I think you need to, I
Yes.
mean, because even I can see that I'm not entirely sure that we've seen the top in the FANG stocks, but I think we are getting very, very close to the top in the FANG stocks, and including Tesla and all other pet stocks also. So I think we are going to it's about also being in the right kind of stocks in that phase here. So if you just long the stock market here, having a kind of general portfolio or something, you can actually be wrong in that market, even if it goes up, because it can be other kinds of stocks that will be going up. So
And
it's not like
there's there's a
it's not like
point
it
on
can
that.
just be long the market.
Yeah,
Yes.
there's a point on that. That's the equal weighted S&P priced in gold put its top in 4 years ago, 2021. So that goes to your point about particular stocks are outperforming that. Particular stocks are still outperforming gold. But if you
Yeah,
give all the stocks in the S&P equal weighting, they broke
yeah,
down and have been declining against gold for
yeah,
nearly 5 years, and they've fallen
yeah.
about 30%. So there's been a
Okay.
30% decline in the equal weighted stock market priced in
Yeah,
gold.
I didn't know that. That's a good perspective. Thank you for that. I didn't know that. And that's a very, very good perspective actually on things, because it shows us also how skewed this kind of rally has been. And it's also, and honestly, I think that's the same thing we see in the economy. We see that we focus on a very, few things there, and then it's if that looks good, well, then everything is fine. I
Mm.
mean, the economy is way more, and the stock market is way more than the FANG stocks. And that's why we cannot just look at that. We need to look at it in a broader perspective. So that, and again, also looking at it versus gold, I think that's a great perspective.
That was it's fun talking to you, Henrik. We should do it more often there. Just because I think we're more aligned than we thought we are, but it's a question of talking about it and nuancing. And because people love clickbait, people that want to just targets and but it's important, like we're geeks about this, we love what we do.
Yeah,
So it's important to talk about this in detail and hopefully people understand more and more our processes. So I'm very happy
exactly,
you came
exactly.
on our show today.
No, no, but I mean, it's for a long time. I've been actually saying, I think for the last 3 or 4 years, I've had a long list of gold miners that I want to buy at the right time, and then gold has been going against me, and you can say, then I look at as I said before, the other, the cousins and the sisters, so silver and platinum, and also the gold miners and so on, and that's the only thing there. Say, well, what is it really happening in that sphere? Gold has been moving up, but is it really because we are in that fantastic gold market, bull market of gold right now? And that I don't think. I don't
No.
think we're in that gold bull market now
But
where we're going to see the 15x on gold. I
Kevin,
think it's there where we have seen. Yeah, I think that's there where we got a 10x or whatever. I think we're there. We're going to see we've seen a small bull market, which I did not anticipate. Take that. Because for whatever reason, supply and demand or whatever, central banks buying it or whatever it can be. But again, I would caution into a deflationary bust. And then the real opportunity for the 10x, 15x is the moment when we see that deflationary bust actually having happened and the Fed comes in with everything
that
placing. And I think that's the only thing that's been different, that's
and
been
that's
different, right?
defined by one simple chart, and that's gold versus SPX. When gold breaks out versus SPX, we go from what has been a gold bull market into the true gold bull era. There's a
Yeah,
difference between a bull market
yeah,
and a bull
we
era.
came up with those.
A
I
bull
agree.
market can occur in a variety of environments, but what we're talking about here is a gold bull era, which
There are,
goes
yeah,
on for years and years and years, and gold doubles,
yeah.
doubles again, doubles again, and doubles again.
I'm with you
That's a
on that.
gold bull era, and that only ever happens when gold breaks out versus the S&P.
It has not
And
happened
to
yet.
your point on the miner, which hasn't happened yet, and to your point on the miners, GDX and the gold miners, SIL, SILJ, HUI, and all of its constituents, really, in our view anyway, are not worth really getting serious about until they break out versus gold. You might as well just
I'm,
hold
I'm,
gold.
I'm,
Gold is doing
and
great.
that's all the thing.
Yeah,
And then I'm 100% aligned, because that's
yeah,
also what I'm saying. I'm not really interested in them just yet. I
Yeah.
will be very interested in it,
yeah.
because it's by the end of the day, when we need sound money coming back and we need to, clean all this mess up that I think we agree on we have right now, then gold will come into focus again, and there'll be a fantastic opportunity with
And
that,
the
and
miners
silver and
usually actually only outperform gold for maybe a couple of years. When you look at
yeah,
GDX versus gold, or you look at the ASA index, which has 50 years of price history versus gold, in these gold bull eras, there's usually just a couple of years where the miners are outperforming gold, but they
yeah,
outperform gold by a very wide margin for a couple of
exactly.
years. So identifying that, taking advantage of it is a really great thing to do if you're nimble enough to do it. But if you're not nimble enough to do it and you haven't got the wherewithal and the knowledge and experience to do it, then simply buy gold when it breaks out versus the S&P. That's kind of what our
And I couldn't agree more. And as I said, I think we are at the Nixon moment here, and that was if people look at that, the SPX as you say, versus gold there, you'll actually see we could be looking right into that. And there is even on that ratio also some divergences that will tell us we are getting closer and closer to the moment where we actually get that breakout. And I like the gold era kind of. I will use that
Yes.
in the future.
Yeah.
Yes. And the yeah, it's all good stuff, man. I could talk for hours. We could talk about this stuff there. It's
And
crazy.
this is the difference between what you see on X, where we're only able to put a post with a few lines and a chart, and people
Right.
make instant assumptions, and they'll remember something and they'll bring it up in 6 months' time. But things have moved on. In 6 months' time, there's new evidence. When you're working as a forecaster, and I've got a background in forecasting, you don't just produce a forecast and then you produce a forecast for a year from now, and then you never change it. You keep going back to your evidence, you keep going back to your inputs, you keep going back to your data. And I know you do this, Henrik, and you have to continually refine that prediction. So starting off, you get a rough estimate of where we're going, and as you get closer to that point in time, as you described very well earlier on, you can refine your target, and that's exactly the way it should work.
Exactly.
Brilliant.
So yeah,
Yep.
so great conversation, and
Yeah.
we got exciting times ahead of us, I'm sure.
Love it.
We
You
have.
want it's time there. Please tell people where they could find all your work, Henrik.
So yeah, I think the best thing is to go on X and find me on at Henrik Zeberg, and there I'll yeah, there'll be an opportunity to reach out to me. I think you actually can reach out to me. I think I'm open for also DMs and anything. So, and I get a lot of DMs, so I'm not sure I can answer everybody, but please do write and also interact, and I'll be most happy to. If you have something of point of view, I love to be challenged in my views. So this that I can go to bed and think, what was that? There's something here I didn't know, or something like that.
Nice.
Then I'll look into it the next day, and I love that. So please do interact.
Exactly. It's all a
Yeah.
learning experience. I put this on my Twitter feed at the start of the year. Remember, everybody, guys, we're just trying to all put our heads together here to plot a chart through what's coming in 2025 and beyond. And it's going to be a rough ride. And so, take it as it's intended. We're here to try and help. Not it's not we're not against each other. We're all trying to learn from each other here.
Beautiful. Thanks, Henrik. Really appreciate your time. And let's
Thank you very much
catch
for
up.
having me on, guys, and let's catch up. Yeah, absolutely,
All
would
right,
be fantastic.
beautiful.
Let's do that when we get down the road.
All right,
Cheers,
man.
Henrik.
Thanks.
Bye.
Bye.
Please subscribe, like, and hit that notification bell. Thanks, guys.